the day.
That's right. In terms of prepayment privileges, do you think fixed mortgages normally have better terms or variable terms?
Yeah. At the end of the day, the question is, do you end up on the street with no home, or do you try to keep the person's property and, make sure that they have a roof over their head and is able to manage that for the next year or two?
So I was going to ask you, how do you approach helping clients who have complex financial situations with credit challenges? You pretty much answered that question. So the main step is to basically advise them on how to solve those problems with some short-term solutions, and then basically graduate to A lenders.
Exactly. You said it. Graduating the client, right?
They will give it to you after the renovation.
After the
and if you fail to do so, and if the lender doesn't approve it, then...
So if you decide to change those renovations, or say that there was work that was done that didn't get done, those lenders will do a holdback. What they'll do is they'll take that amount, the remaining amount, or whatever the difference is, and they'll apply it as a lump sum to your mortgage, to the principal. But you're still paying, obviously, the mortgage for it because that's what you qualified for. Right. So that's a unique program. But even going back to like what first-time home buyers should be more aware about, it's, the budgeting aspect of things, making sure that you understand all the costs associated, property taxes, condo fees or maintenance fees if you're buying a townhouse condo or just a regular condominium, because that stuff increases each year. It doesn't go down, right? Property taxes tend to go increase as well. Then you got land transfer tax that we talked about earlier. Toronto, you get penalized for provincial and municipal. Outside Toronto, yes, it's just provincial. Now, first-time home buyers, you do get a first-time home buyer's rebate on it, but it's not. I believe it's capped up to $4,000 on it, right? So those are things you got to keep. One-time use, first-time home buyers only. Not if you're buying your second property or rental. Otherwise, you're paying the full land transfer tax for that, right? Other things you got to keep in mind: closing costs. Some lenders, depending on how much of a down payment you're putting down, they will likely want you to see usually about 1.5% of the purchase price available as your closing cost. That's in addition to your down payment. Now, keep in mind, they may not say you need to give us the 1.5%. They want to see that you have it available via, say, a bank statement that the funds are sitting there. Now, there are times where you may not need to provide that confirmation if you're putting, say, bigger of a down payment, or if we can factor it into your qualifying ratios. But that's some advice for first-time home buyers. Second, discuss what type of product you want. Are you fixed? Are you variable? Typically, if you're somebody who's on a budget, you should likely consider probably going into a fixed term, right? If you are somebody with, maybe commissions and your income's all over the place, up and down, you might be okay, and you're willing to take high risks and you're making great money. You might be being okay taking a variable, right? But then
not in this market though, because the variable
you still
rates
can. So variables are
quite
still good, because if we know that the Bank of Canada is planning to drop that overnight lending rate, it will only benefit borrowers, because it's going to be, right now variable rates are being discounted, right? So it's prime on average is 6.70%, right? So you're getting a discount. Depending on the type of mortgage, whether you're putting 20% down or less, it can range anywhere from prime minus 0.5% to prime minus 0.9.
What rate are we looking at here?
Usually, still relatively, probably I would say around 5.9, 6%.
How long does it take to get to the fixed rate that we have today?
Well, it depends on how quickly the Bank of Canada is going to drop, right? So Bank of Canada meets 8 times a year. So if they continue to drop, then it can benefit a lot of investors. Now, one thing you got to keep in mind is this. When it comes to variable rate mortgages, there are 2 types of variable rate mortgages. There is the adjustable rate mortgages. And what I mean by that is that if the prime rate changes up or down, your payments will change up and down. It gets recalculated again. Not every institution offers it, but a lot of institutions do offer it outside of, say, the big banks. Most of the big banks do offer a thing called a static variable. So let's say, for example, you have a TD or a CIBC, right, or RBC. If the clients get a mortgage and they qualify for the variable rate mortgage, that's going to be their set payment for the entire term. So if the prime rate goes down, their payments still stay the same. They're just paying less interest and more into principal. right? And then you have like a Scotia Bank or a National Bank, or you have like a First National, a Strive, Capital, these type of other lenders that are still A lenders. They're backed up by these big institutional lenders. They're not B lenders. They have adjustable rate mortgages, right? So sometimes it can be more in favor. The question is, how quickly do you want to pay down that mortgage, right? Some prefer, let my payments be adjusted, right? So in the markets when interest rates are going down, it might make more sense to go into an adjustable rate mortgage because your payments are going to go down and you can't really predict the future. Now, one thing I always hear is there are some people who say, well, life is variable, so you should just take a variable. I would call BS on that. I don't think that is the way you should be looking at things. Not the best strategy
for everybody, right?
Exactly. We have to look at the average everyday consumer that are usually living paycheck to paycheck and they need a budget. So consider fix, maybe a shorter term for now, see where the market goes in 2025, 2026. Those are things you got to keep in mind. I think Integrity, we even work on budgeting as well. We have budgeting worksheets that you can work with. The government also has a budgeting plan that you can work on. These things that can kind of plan you for that future. You can also get, financial advice, right? If you have a lot of investments, seek out your financial advisors, see, and understand whether this makes sense also for you to buy. But like I said, with Integrity, we look at things from a holistic standpoint. We're going to talk about your current situation, your future. And when I mean talking about future, I always ask clients, are you, if you're married, okay, when are you getting married? You guys planning on having children? I know it might be an awkward question, but you never know, right? Because if they say, we're gonna start having kids right away, and then all of a sudden they have one or two, and they bought a 500 square foot condo, you're likely gonna say, don't go into a 5-year term if you think you're gonna start doing this because you might want to upgrade. Maybe you want to buy a detached home, right? So you have to look at all of that, and that's what a good mortgage broker will do, is asking the right questions and really, really exploring, because the whole point of them is about discovering who this client is, right? And you're looking out for their future. This is somebody's largest investment that they're making. So to think of it as a joke, I think any brokers who do that, they shouldn't be in the industry, right? If you're not really taking care of the client at the end of the day.
That's right. In terms of prepayment privileges, do you think fixed mortgages normally have better terms or variable terms?
Yeah, so it all relatively depends, because prepayment privileges, I think there's a couple of things. If you're looking at ways, one, to pay your mortgage down faster, most lending institutions, it all depends on the lender you go with, they'll allow you to pay down your mortgage typically by increasing your payments, let's say by 10% to 20%. Of what your original payment was. In addition to that, some of them will allow you to make a lump sum payment anywhere from 10 to 20% towards the principal without being penalized. Okay. Once, if you start breaking the mortgage, so those are things you got to factor in. Ask your broker that, break it down, saying, if my goal is to pay down my mortgage as quickly as possible, then you're probably wanting a lender that's giving you 20% prepayment options, right? If you don't really care about that and you're chasing more just the interest rate, then sure, you might find a lender that may offer, a lower rate, but maybe their prepayment might be 10% on the increase of your payments and 10% lump sum payments, right? This is where I think individuals need to look at it and saying, if I get bonuses from work, or I get massive annual bonuses or monthly bonuses, or I'm somebody on commission, maybe to help reduce that principal, start utilizing those funds and placing them towards the principal as lump sum payments or increasing those payments. Now, you can always reduce that. You don't have to, say, put a full 10% down or 5%, or 20% of the lump sum amount. You can, I think most lending institutions, the minimum is $100,000 that they want you to apply as a lump sum payment. And that can help you reduce the amount of interest you pay over time. That can also help you reduce your amortization as well. When it comes to, say, prepayment penalties, that's a little bit different. Lending institutions also vary, because those, if we're looking at fixed rate mortgages, they're typically 3 months interest or the interest rate differential. Okay. However, some might have 2% of the balance or 3% of the balance, right? Those special interest rate promos that you are not reading the fine print on, and then all of a sudden, you're screwed.
It's very important for everybody to check their mortgage offer letter or the mortgage terms that they have.
The mortgage term, understanding the product, why you're going into it, what's your future plans. When we're looking at variables, there's usually for variables as well, the penalty is typically 3 months interest on the contract rate. However, there are institutions out there who calculate the penalty on 3 months interest based on the prime rate. So it's not going to be your contract rate. So again, make sure you know who your lender is, that you're getting educated about them, why they exist, what the penalty structure is. This stuff will all be listed on your mortgage approval, but make sure that penalty is always discussed, because you don't know what your future plans are, right? You might have an idea and you might say, oh, it's 5 years, that's not a big deal, right?
A lot of things,
but a lot happens in a year from now, 2 years from now, and then all of a sudden, somebody passes away and you're like, I need to sell the property, and you end up with, say, a $30,000-$40,000 penalty. I remember clearly back around 2011, 2012, when interest rates were coming down to 2.99% and they were around 5-6%. People that were wanting to break their mortgage, the highest penalty I ever saw break was almost about $78,000.
Ooh, that's a lot.
And that's why earlier I was saying it's not just about the lowest interest rate. You gotta factor in as well. If you have a high rate today and you're coming up for renewal, right? Mortgage renewals, billions and billions coming up. People
in
are
2025.
Yeah, 2024, 2025, 2026. There's a lot coming up. And you know what? Anybody who has those high interest rates, if they're renewing today, or let's say by the end of this year, they're going to get a bit of a hit, especially if they got their mortgage in 2021, 2020, because those are usually typically, those 5-year renewals are coming up. So if you got that amazing interest rate where it was like 1.5% to 2%, guess what? In my personal opinion, I don't think those rates are going to come back. Unless we maybe have another pandemic, but I don't think anybody's wishing upon
or World War III.
Yeah, or World War III, right? So, look, there's so much to think about. And I think that's something we don't expect the consumer and clients to know. But when you're dealing with a mortgage broker, that's where they come into place of the education piece, right? They're supposed to teach you all these, ask you the right questions. Now, I will say you may not get that working with somebody directly at a bank, right? The difference between a mortgage broker and a bank, if I can touch on this a little bit, is somebody that works at a bank. They are a banking specialist. They're a mortgage specialist. They're not going to take a course. They're not getting licensed. They are taught through the institution, and they
can only work with that.
Yeah, they can only offer their products. They only know their products, right? Yes, they might go outside of their day-to-day job and try to read up on the market and stuff, but you may not get the right product. They may not ask you all the right questions. And keep in mind, they are employees, right? They're not entrepreneurs.
They have the best interests of that institution in mind.
Exactly. Right. Big banks are about profitability. They're about, meeting their quota every month, this and that. That's why they push, and that's why they might sometimes be a bit more aggressive, right? But if that employee gets fired or they quit their job, that mortgage specialist is no longer a person. Whereas a mortgage broker, this is our livelihood. We're just like realtors, 100% commission individuals. We get paid through the institutions. Yes, we're not really charging the clients unless it's a complex deal with a private or a B lender. But even at that, with that being said, at the big banks, somebody leaves, they mess up your entire mortgage, they gave you the wrong advice, and now they're no longer there. Yeah, you're going to go yell at the bank,
you're gonna have to.
There's no repercussions for that individual. Whereas a mortgage broker, we have to provide extra due diligence. We got to make sure you're taken care of because we're governed by the regulatory bodies of FSRA, right? And we're going to live and breathe because this is our daily, our daily money that we need,
and
our daily bread.
At risk too,
our reputation's
right?
at risk. Exactly. And that's why mortgage brokers work so much more harder. I'm not going to discredit mortgage specialists that they don't, but, we have more responsibility, a fiduciary duty to the public to making sure that we are treating them ethically and also obviously with integrity and all of that. So that's what I would say. Now, I'm not going to say that every mortgage broker is perfect out there, right? You're always going to have bad seeds, whether it's in the banking side or on the broker side. But as consumers and borrowers, interview your mortgage broker. Ask them, what's their experience like? How long have they been doing this? Have they ever dealt with clients like this? What do they normally tell their clients? And they'll be able to answer it, right? You'll get an idea of who they are. Ask them personal questions. Why are they in this industry?
If they're not transparent, those are red flags.
Yeah, exactly.
People have to avoid, right?
Exactly, right? So those are things that, I would say first-time home buyers, credit as well. Credit plays a part in the day-to-day for first-time home buyers, because that can determine your qualifications, whether you end up with an A lender, a B lender, or say you end up with a private lender, right? We talk about utilization, keeping those balances down. If somebody has high balances, we have to bring it down. You typically want to try to bring it down, below 70%, but even at 70%, that's still high. Where people's credit scores start to get impacted is once they hit above the threshold of 30%. Mortgage inquiries, if you're somebody who's constant credit seeking, that's different. Yes, you're going to have an impact to that score. But if you're somebody who's like applying for 10 different credit cards in 1 month, right? But it is healthy. And I'm going back to misconception. People think pulling their credit is a bad thing. It is healthy for you to pull your credit once a year, okay, to see where it stands. It's not going to hurt you a lot. It's about the inquiries play about maybe a 5% weight. What matters most is history on your credit. How long have you had it? And be careful of that, because if somebody tells you, or a mortgage broker says you have to pay out all your debt and close those accounts, you eliminated your history. So if you had something for 10 years and now it's no longer there, your credit score is probably not going to be the greatest, right? So you have to be careful. I always say keep the longest historical trade that you have, because that's going to matter the most, and say something with high limits and low balances. Always try to maintain 2 trades at all time. And when we talk about trades, we're talking about credit cards, car loans, preferably 2 major credit cards if you can, right? Over $1,000 on a limit if you can. That plays a huge part.
Utilization should be 30% though.
Should be 30%, but once it starts going above, where it starts to impact as you get higher and higher, the credit score will start, but where it really negatively impacts is once it hits 70% of utilization.
I see.
Yeah. So
good to know.
That's something I say consumers need to be aware about, is credit plays a huge part. It can determine your credits. It can determine your interest rate, your qualifications, whether a lender is going to give you exceptions or not exceptions on certain things, because they look at it and everything is a case by case scenario. Not to say that those who have bad credit, we can't help. We can definitely help you as well. But usually with bruised credit or missed payments or previous consumer proposals, bankruptcies, anything like that, property taxes owing, those typically end up on the alternative side. There are solutions, but it comes with a price of higher interest rates. And these are 1 to typically 3-year term mortgages. Again, short-term solution, get better, improve your credit, take you back to the prime A side, right? And that's what we're also seeing. We're seeing a lot more B business these days in this market, and a lot of private business, because, again, there's an affordability issue. Some people can't qualify on the A side because they're so much more strict. So B lenders kind of give more flexibility, right? So, at the end of the day, the question is, do you end up on the street and with no home, or do you try to keep the person's property and, make sure that they have a roof over their head and is able to manage that for the next year or 2?
So I was going to ask you, how do you approach helping clients who have complex financial situations with credit challenges? You pretty much answered that question. So the main step is to basically advise them on how to solve those problems with some short-term solutions, and then basically graduate to A lenders.
Exactly. You said it. Graduating the client, right? And just planning it out, because sometimes you may only need 3 months to fix that credit issue. Sometimes you might need 6 months. Sometimes you need a year. Even if a client does a consumer proposal, there are lending institutions, the B lenders, that will pay out an existing consumer proposal. Even if you just filed it, we can get you out of it, because it
doesn't have to be necessarily 7 years.
It doesn't. We can pay it out through another B lender. So you say you went to go get a consumer proposal because you need to consolidate it, and now you have $20,000, say $25,000 to pay out. If you have equity in that property, we can pay out that consumer proposal and discharge it. On average, a consumer proposal, because you're on a payment plan anywhere from 3 years to 5 years, that can take some time. So to start fresh again, try to refinance if you can with a B lender, because it all starts from that discharge date. So once we pay it out, now you are going to be working towards getting new trades, not your existing ones, brand new ones after discharge, because you're going to need likely around 2 years history of these 2 trades so that we can place you back with an A lender.
I see. Okay. What should clients be asking their mortgage brokers that they often overlook?
What should clients be asking mortgage brokers? What they often overlook. Why are we using this lender?
Okay.
I would say that. I would also say
Why does it matter?
Because the lender who you go with does matter, because you want to understand that you're putting them at comfort level. The problem that I would say it's a problem, but not a problem, is that a lot of borrowers believe that only the big banks offer mortgages, right? What they don't realize is that there's other good lending institutions out there that sometimes can have competitive rates, sometimes better penalty structures, right? A big bank, they're always going to charge you much higher penalties as opposed to a non-big bank, right? So lenders like First National, MCAP, Strive have a lot better of a penalty structure. Sometimes it's worth paying a 0.05 difference on an interest rate, so you can save for that future of paying thousands of dollars less, exactly. Right? So it all depends. And a lot of these mortgage finance companies that are not banks, they're still institutional lenders. They also are backed up by some of the big banks as investors, right? So in Canadian history, I don't think we've ever seen a financial institution mortgage lender ever go into bankruptcy. Worst case scenario, what happens if somebody exits out, somebody buys and ends up buying that book of business, right? So that's always a good thing to know that there are other options, and don't just stop at the big banks and say, I can't get a mortgage. They denied me. Speak to a mortgage broker, because we're going to have other options and solutions. That's why we exist. And that's why some of these lenders, you can only get access by dealing with a mortgage broker, right? Because they are working for exclusively only with mortgage brokers. You can't just call them and be like, hey, I'm a client, I need a mortgage, because guess what they're going to say? We're going to refer you out to another mortgage broker.
That's right. Now, how can clients become more informed and proactive in their mortgage planning?
I would say subscribe to a lot of media stuff, not just media stuff, but subscribe to like your mortgage broker.
It can be confusing if you subscribe to every channel out there.
I would say partner with a mortgage broker. Most mortgage brokers should have a newsletter that they're sending out. Get that advice from them, because going back to Shayan, your comment there, sometimes the media can portray things to be the worst. It's doom and gloom, yada, yada, yada. And that's not always the case, right? Being in this industry for this long, I always tell my clients is that don't believe everything you hear, right? And say, if we look at our finance minister, he told us interest rates were going to remain low for, the next 2-3 years. And then what happened? Inflation rose, interest rates were forced to increase. And look where the economy was, right? So those are things you got to factor in. The guy who brought interest rates really low also had increased interest rates. And the people who are living and breathing the day in, day out of these transactions, or even dealing with clients and, speaking to clients and seeing these different types of deals coming through, they're the ones who are going to give you the best advice, not what the media is telling you, right? Yes, you can have those questions saying, well, I heard this, I heard that, but the media said this and the media said that. That's, not always accurate.
Not always accurate.
So everybody's situation is different and unique. That's what I would say.
Awesome.